Did you know that a new IRS rule has just been implemented that could end up costing senior citizens thousands of dollars in unexpected taxes, penalties, and financial complications if they're not aware of it and don't take the proper steps to comply? This isn't a proposal or something that might happen in the future. This is a rule that's already in effect right now, and it's catching many retirees, Social Security recipients, and seniors completely off guard because they simply don't know about it or don't understand how it affects their specific situation. Whether you're already retired, approaching retirement, receiving Social Security benefits, or managing retirement accounts, this new IRS rule could have serious implications for your finances, and you need to understand exactly what's changed and what you need to do to protect yourself. Welcome back to U.S. Immigration Intel, your most trusted and comprehensive source for critical information about taxes, retirement, Social Security, financial planning, legal updates, and everything that affects seniors and retirees here in the United States. I'm here today to break down this new IRS rule in clear, understandable terms, explain exactly who it affects and how, show you real-world examples of how much money could be at stake, tell you what specific actions you need to take right now to avoid costly penalties and tax bills, and give you strategies to minimize the impact on your retirement income and savings. This video is absolutely essential viewing for anyone over the age of 55, anyone receiving Social Security or pension income, anyone with retirement accounts like IRA or 401k plans, and anyone helping elderly parents or relatives manage their finances. Make sure you watch until the very end because I'll be sharing important deadlines, forms you need to know about, and resources that can help you navigate this change. Don't forget to subscribe to U.S. Immigration Intel and hit that notification bell so you never miss critical updates like this that could save you thousands of dollars. Let's dive straight into what this new IRS rule is all about and why it matters so much to seniors. The IRS has implemented new reporting requirements and enforcement mechanisms related to required minimum distributions, commonly known as RMDs, from retirement accounts. If you have money in traditional IRAs, 401k plans, 403b plans, or other tax-deferred retirement accounts, you're required by law to start taking minimum withdrawals from these accounts once you reach a certain age. For many years, that age was 70 and a half. Then it changed to 72 under the Secure Act of 2019. And now under the Secure 2.0 Act that was passed in 2022 and is being phased in, the age has been raised to 73 for people who turned 72 in 2023 or later, and it will increase to 75 for those who turn 74 in 2033 or later. The new IRS rule we're talking about today involves stricter enforcement of these RMD requirements, new reporting obligations for financial institutions, increased penalties for failing to take your required distributions, and new tax withholding rules that affect how much money you actually receive when you take distributions from your retirement accounts. Here's why this matters so much and why it could cost you thousands of dollars if you're not careful. First, the penalty for missing your required minimum distribution has always been severe, but it's been modified under the new rules. Previously, if you failed to take your RMD by the deadline, you faced an excise tax penalty of 50% of the amount you should have withdrawn but didn't. That's right, 50%, which is an absolutely massive penalty. Under the Secure 2.0 Act, this penalty has been reduced to 25%, and it can be further reduced to 10% if you correct the error within a specified correction window. While this reduction sounds like good news, and it is compared to the old 50% penalty, 25% is still a huge amount of money to lose. If your required minimum distribution was $20,000 and you forgot to take it, you'd owe a $5,000 penalty. And that's on top of still having to take the distribution and pay regular income tax on it. So you'd end up taking the $20,000 distribution late, paying income tax on it, which could be $4,000 to $6,000 depending on your tax bracket, plus paying the $5,000 penalty. meaning that oversight could cost you nearly half of the distribution amount. The second major issue with the new IRS rule involves increased reporting and tracking. Financial institutions that hold retirement accounts are now required to report more detailed information to the IRS about account holders who are subject to RMD requirements, including whether the account holder took their required distribution and the amount that was required versus what was actually withdrawn. This means the IRS has much better data to identify people who miss their RMDs, and they're using automated systems to catch these errors and send out penalty notices. In the past, you might have gotten away with missing an RMD because the IRS didn't always catch it or there were delays in their enforcement. Those days are over. The new systems make it almost certain that if you miss your RMD, you'll be caught and penalized. The third component of this new rule involves tax withholding. When you take distributions from traditional retirement accounts, federal income tax is typically withheld from the payment unless you specifically elect not to have withholding. The default withholding rate is 10% for most distributions. However, under new IRS guidelines, there are situations where higher withholding rates may apply, particularly for large distributions or for people who have had tax underpayment issues in the past. Additionally, there are new requirements for how financial institutions handle withholding elections. And if you don't properly document your withholding preferences, you could end up having too much tax withheld, which means less money in your pocket each month, or too little tax withheld, which means you'll owe a large tax bill when you file your return, and you could face underpayment penalties. Let me walk you through some specific scenarios to help you understand how this affects real people. Scenario 1. Margaret is 74 years old and has a traditional IRA worth $400,000. Based on the IRS life expectancy tables, her required minimum distribution for this year is approximately $15,500. Margaret is still working part-time and doesn't really need the money from her IRA right now, so she simply forgets about the RMD requirement. She doesn't take any distribution during the year. In April of the following year, when she's preparing her taxes, she realizes her mistake. Under the new rules, she faces a penalty of 25% of the $15,500 she should have taken, which is $3,175. She also still has to take the distribution and pay income tax on it. If she's in the 22% federal tax bracket, that's another $3,110 in federal income tax plus potentially state income tax, depending on where she lives. Her failure to take a required distribution that she didn't even need for living expenses has now cost her over $7,000 in taxes and penalties combined. Scenario 2. Robert is 76 and receives Social Security benefits. Plus, he has a traditional IRA. He knows he needs to take RMDs and he does take a distribution each year, but he's confused about the withholding rules. His financial advisor takes a distribution of $18,000 from his IRA for his RMD, with the standard 10% withholding of $1,800 taken out for federal taxes. Robert receives $16,200. However, when Robert files his tax return, he discovers that because of his Social Security income, his pension, and his IRA distribution, he actually should have been in the 24% tax bracket. The 10% withholding wasn't nearly enough. He ends up owing an additional $2,500 in federal income tax when he files his return. Plus, he owes an underpayment penalty of several $100s because he didn't have enough tax withheld throughout the year. If Robert had understood the withholding rules and had increased his withholding to 24% or made quarterly estimated tax payments, he could have avoided this surprise tax bill and penalty. Scenario 3. Linda and Thomas are a married couple, both in their early 70s. Linda has a traditional IRA and Thomas has a 401k from his former employer. They both reach the age where RMDs are required. Linda takes her RMD without any issues, but Thomas forgets that the 401k is subject to separate RMD rules. He thinks that because Linda took her distribution, they've satisfied the requirement not realizing that each person must take RMDs from their own accounts and you can't combine them between spouses. Thomas's failure to take his RMD results in a substantial penalty on the amount he should have withdrawn from his 401k. This scenario highlights a common misunderstanding that costs many couples thousands of dollars. Now let's talk about what you need to do to protect yourself from these costly mistakes and ensure you're in full compliance with the new IRS rules. First, and most importantly, know your RMD age and requirements. If you turned 73 in 2023 or will turn 73 in 2024 or later, your RMD starting age is 73. You must take your first RMD by April 1st of the year after you turn 73. For example, if you turn 73 in 2024, you must take your first RMD by April 1st, 2025. However, and this is crucial, if you delay your first RMD until April 1st of the following year, you'll also have to take your second RMD by December 31st of that same year, meaning you'll have 2 distributions in 1 year, which could push you into a higher tax bracket. For this reason, many financial advisors recommend taking your first RMD in the year you turn 73 rather than waiting until April 1st of the following year. Second, calculate your RMD correctly. Your RMD is calculated by dividing the balance in your retirement account as of December 31st of the previous year by your life expectancy factor from the IRS Uniform Lifetime Table. The life expectancy factor changes each year and decreases as you get older, meaning your RMD amount increases each year even if your account balance stays the same. Most financial institutions will calculate your RMD for you and send you a notice, but it's your responsibility to make sure it's taken. Don't assume your bank or brokerage will automatically send you the distribution. While some institutions offer automatic RMD distribution services, many don't. And even if they do, you have to specifically enroll in this service. If you have multiple retirement accounts, you need to calculate the RMD for each account separately. For traditional IRAs, you can total up all your IRA RMDs and take the full amount from one IRA or split it among them however you want. But for 401k plans and other employer retirement plans, you must take the RMD from each plan separately. Third, set up a system to ensure you never miss an RMD. Put reminders in your calendar or phone for October or November of each year to check on your RMD and make sure it's been taken. Many people choose to take their RMD early in the year to get it out of the way and eliminate the risk of forgetting. Consider setting up automatic monthly or quarterly distributions from your retirement accounts. This spreads out your income more evenly throughout the year, which can help with budgeting and may also help with tax planning by keeping you in a lower bracket. Work with a financial advisor or tax professional who can track your RMD requirements and send you reminders. Keep good records of all distributions you take, including the date, amount, and which account it came from. If the IRS ever questions whether you took your RMD, you'll have documentation to prove you did. Fourth, understand and manage your tax withholding properly. Review your current tax withholding on retirement account distributions to make sure it's appropriate for your situation. If you have other sources of income like Social Security, pensions, or part-time work, you may need to have more than the standard 10% withheld from your IRA distributions. You can adjust your withholding at any time by submitting a new Form W-4P to your retirement account custodian. Alternatively, if you prefer to manage the tax yourself, you can elect to have zero withholding from your distributions and instead make quarterly estimated tax payments to the IRS using Form 1040-ES. This gives you more control, but requires discipline to set aside the money and make the payments on time. Consider working with a tax professional to project your total tax liability for the year and determine the optimal withholding strategy. This is especially important if you have income from multiple sources or if you have significant deductions and credits that affect your tax situation. Fifth, Be aware of special rules and exceptions. If you're still working at age 73 or older and you're still participating in your employer's 401k plan, you may be able to delay RMDs from that specific plan until you retire. But this still working exception doesn't apply to IRAs or to 401k plans from previous employers. Roth IRAs are not subject to RMD requirements during your lifetime, which is one of the major advantages of Roth accounts. However, Roth 401k plans were subject to RMDs under the old rules, but the Secure 2.0 Act eliminated RMDs for Roth 401k plans starting in 2024. If you inherit a retirement account from someone other than your spouse, different RMD rules apply, and these were significantly changed by the Secure Act. Most non-spouse beneficiaries must now withdraw the entire account within 10 years. Though there are exceptions for certain eligible designated beneficiaries, like minor children, disabled individuals, or beneficiaries not more than 10 years younger than the deceased. Sixth, consider qualified charitable distributions, or QCDs, as a tax-efficient way to satisfy your RMD requirement. If you're 70 and a half or older, you can direct up to $100,000 per year from your IRA directly to qualified charities. These distributions count toward your RMD requirement, but are excluded from your taxable income. This is an incredibly powerful tax planning tool, especially if you don't need your RMD for living expenses, and you normally make charitable donations anyway. The QCD allows you to satisfy your RMD, support causes you care about, and reduce your tax bill all at the same time. To qualify, the distribution must go directly from your IRA to the charity. You must be 70 and a half or older at the time of the distribution. The charity must be a qualified 501c3 organization, and you cannot receive any goods or services in return for the donation. You also can't claim a charitable deduction for a QCD since it's already excluded from income. But the tax benefit of excluding it from income is usually better than taking a deduction, especially given the high standard deduction that most seniors use. Let me also address what to do if you've already missed an RMD or if you discover you made an error in a previous year. The IRS has a process for correcting missed RMDs and potentially getting the penalty waived or reduced. If you discover you missed an RMD, take the missed distribution as soon as possible, even if the deadline has passed. Then file IRS Form 5329, which is the Return for Additional Taxes on Qualified Retirement Plans. On this form, you'll calculate the penalty you owe, and you can request a waiver of the penalty by explaining the reasonable cause for missing the RMD. Reasonable causes might include serious illness, a death in the family, incorrect advice from a financial institution, or other circumstances beyond your control. Attach a letter explaining what happened, what steps you've taken to correct the situation, and why you're requesting the waiver. The IRS has been fairly generous in granting waivers for first-time mistakes or when there are legitimate extenuating circumstances, but you must be proactive in taking corrective action and requesting the waiver. It's also important to understand how Social Security benefits interact with RMDs from a tax perspective. Many seniors are surprised to learn that their RMDs can cause more of their Social Security benefits to become taxable. Social Security benefits are taxed based on your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. If your combined income exceeds certain thresholds, up to 85% of your Social Security benefits can be subject to income tax. When you take an RMD from a traditional retirement account, that counts as taxable income and increases your adjusted gross income, which can push you over the thresholds and cause more of your Social Security to be taxed. This is sometimes called the Social Security tax torpedo. Strategic planning around when and how you take retirement account distributions can help minimize this effect. Some strategies include taking larger distributions before you start Social Security if you delay claiming benefits past your full retirement age, converting traditional IRA money to Roth IRA in lower income years before RMDs start, or using QCDs to satisfy RMDs without increasing your adjusted gross income. Another consideration is how RMDs affect your eligibility for various programs and benefits. Higher income from RMDs can affect your Medicare Part B and Part D premiums through income-related monthly adjustment amounts, or IRMAA. If your modified adjusted gross income exceeds certain thresholds, you'll pay higher premiums for Medicare. The income used to determine IRMAA is from 2 years prior, so your 2024 Medicare premiums are based on your 2022 tax return. Large RMDs can push you into higher brackets, significantly increasing your Medicare costs. Additionally, if you're receiving any means-tested benefits or assistance programs, increased income from RMDs could affect your eligibility. This is another reason why tax planning around retirement distributions is so important. Let me share some advanced strategies that wealthier seniors or those with substantial retirement accounts should consider. If you have more retirement savings than you'll need for your lifetime, and you're concerned about leaving a large tax burden to your heirs, consider accelerating distributions or doing Roth conversions before RMDs begin. This allows you to control the timing and potentially spread the tax impact over multiple years in lower brackets. If you have a younger spouse, you can use the Joint Life and Last Survivor Expectancy Table for calculating your RMD, which results in a smaller required distribution each year because it factors in your spouse's longer life expectancy. Consider purchasing a Qualified Longevity Annuity Contract, or QLAC, which is a special type of deferred income annuity that you can purchase with up to $135,000 or 25% of your retirement account balance, whichever is less. The amount invested in a QLAC is excluded from your RMD calculation until age 85, effectively reducing your RMDs in your 70s and early 80s. Thank you so much for watching U.S. Immigration Intel today. If you found this information about the new IRS rule affecting seniors valuable and important, please give this video a thumbs up and share it with other retirees, seniors, friends, family members, or anyone else who needs to know about these tax rules and how to avoid costly penalties. We're here at U.S. Immigration Intel every week, bringing you critical, accurate, and up-to-date information about taxes, retirement, Social Security, Medicare, financial planning, and everything that affects your life and financial security as a senior in the United States. Subscribe to U.S. Immigration Intel if you haven't already, and make sure to turn on notifications so you never miss important updates that could save you thousands of dollars or help you make better financial decisions. Stay informed, plan ahead, consult with qualified professionals when needed, and I'll see you in the next video with more essential information for seniors. Take care and stay financially secure.